inflation's baked in the cake. There's only two alternatives. There would be a depression and a reset. In other words, we could have an honest default where we said to the bondholders, too bad, so sad, no money, strong letter to follow. Or we could have a fraudulent reset, inflation, kick the can down the road and deal with it by gradual devaluation. I suspect that we'll choose to kick the can down the road.
Rick Rule, President and CEO of Rule Investment Media and co-founder of BattleBank and a quarterly contributor to this show. It is so wonderful to welcome you back and great to see you as always, Rick. We always enjoy having you on the program.
Pleasure. Nice to be back with you. Thank you for inviting me back.
It's great to have you back. And for folks watching and listening, Rick, you do have a symposium coming up. And so folks don't have to wait till the very end of the show to get details. Can you just let folks know when and where it's happening, how they can sign up, and then we'll get into the conversation.
One of my favorite topics, Julia. Thank you. The Rural Natural Resources Symposium is about in its 30th year. It's held July 7 through 11 in Boca Raton, Florida, or importantly, via live stream, wherever you happen to be. Whether you attend live or via live stream, we have a unique offer, which is this. Whether you attend live or live stream, you have an ironclad money-back guarantee. If for any reason you don't think that you got your money's worth out of the symposium, I'll give you your money back. A financially riskless transaction, one that doesn't happen very much anymore. How do we do that? Well, pretty simple. We have great macro thinkers, but our macro thinkers aren't influencers or journalists. They're people who live the life in the organizations that they talk about. An example would be David Stockman, talking about the budget. He ran the Office of Management and Budget under the Reagan Revolution. He wrote the book, The Triumph of Politics, which describes how Democratic and Republican senators derailed the Reagan Revolution within 6 months of inauguration. His comments around the Department of Government Efficiency come, in a biblical sense, from the belly of the beast. He was a player. Daniela DiMardina Booth will talk to you about the Fed, not as a journalist, but rather as a former Fed researcher. Nomi Prinz will talk about the structure of Wall Street, having been a partner at Goldman Sachs. You get the picture, Julia.
Oh, yes.
Players, not journalists. We move on to analysts who've been in the natural resource space 30 years, people who've made money in bear markets and bull markets and know the difference between the two. We move on from there to the living legends, people who have built multi-billion-dollar oil and gas or mining companies from scratch, telling you how they did it, and more importantly, telling you how to identify the $15 or $20 million market cap company that could be a $2 to $3 billion market cap company. So I look forward to hosting all of you, either live or via live stream. By the way, we will give you between 50 and 55 hours of programming over 4 days, more than you can possibly absorb. To that end, we record every part of the proceedings, all the breakout sessions, everything. You'll have access to the tapes for 12 months after the conference, and you'll need it. We give you more programming than you can absorb. Further, we interview every single exhibitor and every single speaker before the conference. Those interviews are available to you whether or not you attend the conference. You can find them at the Rule Classroom or at the Rule Investment Media site on YouTube. Repeat, every single exhibitor and every single speaker at the conference has been interviewed or will be interviewed before the conference. So you come to the conference better prepared to allocate your time and capital efficiently.
I love it. And what a great lineup. And some of the folks are also friends of this show. We have yet to get David Stockman on. He is definitely one of our dream guests to get on the program at some point, but it sounds like an amazing lineup. And we will leave a link for folks who are watching and listening in the show notes. So go and support Rick and the incredible work he's doing with the symposium. All right, Rick, it's been a while. The last time we had you on was right before the inauguration. You were our last guest before Trump took office, and we have you on every quarter now, and gosh, we got to get your update on everything that's happening in the world. So let's start with the big picture, more of that macro view, where we are today, where you see things headed, what is on your radar, what are you thinking about? So let's start there. And as you know, Rick, you can take all the time you need to set the table.
Well, I guess the good news about Trump is that a bunch of topics that were off the table are now open for discussion. I also need to say, in my uncharitable moments, that I love who he's made angry. I don't like the fact that the country is more angry, but I do like who he has made angry. My suspicion is that if he makes the socialists more upset, that they'll focus their ire on him as opposed to on me. And I think that's a good thing. I think everything else has been a disaster, much as we talked about before he was inaugurated. Let's start with the Department of Government Efficiency. If you were going to cut the size of government, why would you pass a budget that proposed to take the debt ceiling off and runs the fourth largest projected deficit in history? Department of Government Efficiency has been an out and out failure. Mm-hmm. If there was any of the fraud that they claimed there was, where are the indictments? Fraud is an indictable offense. I've seen no indictments. The cuts, where are the cuts? All I see is spending. The spending increases now. The cuts occur 3 or 4 years from now. In that regard, I think he's a politician. I think like the rest of them, including those that preceded him, you can tell he's lying when his lips are moving. Tariffs. Tariffs are taxes. Taxes suck. The idea that the Chinese are going to increase their cost of production to sell you stuff in Walmart is hilarious at best. Tragic, but hilarious. And then foreign policy, the no war president. Now, listen, when I compare Trump with the alternative, which was Kamala Harris, or the predecessor, Biden, probably there's no qualitative difference. Tweedledum, Tweedledummer, interchangeable. But I have to say that the Trump presidency, like the Biden presidency, has been disastrous. What I like, Julia, is this, and we've talked about this on your show. We have an amazing culture in the United States. It's still a can-do culture. It's still a place where 4 or 5 kids can commandeer a garage in Sunnyvale and out pops Google or out pops Apple. What I want your listeners to take away is that what we're coming into is going to be unpleasant, but it's survivable. We will survive it, just like we survived the 70s. And some of us won't just survive, we'll thrive. We are still tolerant, an odd word, of success. And our individual effort and creativity will, over time, finance our collective stupidity. But we have about 10 years of reckoning, I suspect, like we had in the period that was 12 years, 1968 to 1980. We have 10 or 12 years to get through. And that'll be a really, really, really interesting set of circumstances. The arithmetic is challenging. The zeitgeist, if that's the right phrase, is challenging. The left hates the right hates the left. The great middle is looking nervously to their left and looking nervously to their right and hoping that this field of hatred doesn't consume them too. So it'll be interesting times.
Yes, certainly.
There are ways through this, and history teaches us what some of them are.
I hear you bring up 1968 through the 70s into 1980. I wasn't around then. I've kind of heard anecdotally about that decade. But as someone who was a young man then, can you kind of shed some light? Because I'm kind of sensing that maybe it might be analogous to that time period. How are you thinking about this decade?
Well, I'm thinking about it in two ways. Then as now, there was a demand for service that couldn't be funded. And the way we dealt with that in the decade of the 70s is that we allowed the US dollar to depreciate, not relative to other currencies, but rather absolutely. The Office of Management and Budget tells us that between 1970 and 1980, the absolute purchasing power of the US dollar declined by 75%. So $1,000 in 1980 bought what $250 would have bought you in 1970. And I think past this prologue, I think over the next 10 years, the purchasing power of the US dollar will decline by at least 75%. And I'll tell you the reasons why in a moment. We also came into the decade of the 1970s with a lot of groups in American society, rather than American society itself, feeling entitled, feeling that they had been left out of the distribution of largesse by the government. There was anti-war feeling. I shared that. There was racial antagonism. There was class antagonism. There was sociological antagonism. Each group felt entitled. Each group, in some senses, probably was entitled. But the fact was that they took out the battle for spoils on the streets of the United States. I remember as a young man looking for a place to go to university in California, and several campuses, including Cal Berkeley and San Jose State, basically required gas masks to get to class. I had no particular interest in that. And I think those types of disturbances, the types of disturbances that we're seeing on the streets in the United States, likely continue and likely exacerbate. You don't need to participate in that. There are, I mean, if you look as an example at what's going on in Los Angeles right now, there's about 1% of the city that you have to ignore. You can get on with your life for the most part, provided that you don't let your curiosity take you into a war zone. 3 years ago, you didn't have to be concerned about that. You have to be concerned about that now. But you really, truly need to be concerned about your wealth and your future, particularly you, Julia, particularly somebody your age. My generation, the boomers, we did a lot of great things, but we did a couple very, very, very nasty things. The most important of which is that we voted ourselves all kinds of cool benefits, and we forgot to pay for them. You know, when people of every age look at the balance sheet of the United States and they see almost $37 trillion in debt, they're right to be afraid, but they should be much more afraid of the net present value of off-balance sheet liabilities, Medicare, Medicaid, Social Security. That number, not according to some fat, cranky old libertarian named Rick Rule, but rather according to the Congressional Budget Office, the net present value of unfunded entitlement liabilities exceeds $100 trillion. If you add those two numbers, off-balance sheet and off-balance sheet liabilities, the number that you come to net is around $130 trillion. That's an interesting number because the IRS suggests that the private net worth of Americans, that is our money, yours and mine, is 141 trillion. So we're worth 141 trillion and we owe 130 just at the federal level, not the state level, not the local level, not the individual level. And guess what, Julia? It gets worse.
Oh gosh, tell me.
On-balance sheet liabilities of the U.S. government grow about $2 trillion a year, maybe a little faster under Trump, an overachiever. While the net present value of entitlement liabilities, which is to say Medicare, Medicaid, military pension, Social Security, federal government pensions, that number increases about $2 trillion a year, too. So we have a plurality of net worth over debt of $10 trillion, which we're eroding at $4 trillion per year. Now, how does this work out? Well, the first answer is poorly. But the honest answer to the question is that we're going to have entitlement reform. The eligibility age for Social Security is going to have to go to 70. That makes perfect sense, but people are going to hate it. They're going to be really, really, really mad. And there's going to need to be Medicare reform and other entitlement reform. And there will be people who say, I paid into this for 30 years, I'm being cheated. Correct. Too bad, so sad. That has to happen. But the most important cure, I'm afraid, is that we can honor the nominal value of our obligation by inflating away the net present value. For that reason, I believe that the purchasing power of the U.S. dollar, the absolute purchasing power of the U.S. dollar, declines by 75% over 10 years, similar to the number that declined in the decade of the 1970s. And I mean, I wish I didn't have to say this, but people need to plan. More you, by the way, than me. I've done my planning for 40 or 45 years. Your planning is going to be crowded into a much shorter period of time.
Mm-hmm. Yeah, like I'm going to have to do it more as an individual versus relying on any sort of future Social Security. Let me ask you a question on the Social Security. And I kind of wanted to bring us up from our last conversation. Was part of it because they just did a really crummy job of investing it? It seems like a lot was paid into. Couldn't they have just like made smarter decisions around, I don't even know if you're allowed to invest it, but
They
You know?
made politically expedient decisions. What happened to the Social Security surplus is that it wasn't invested, it was spent.
Okay, yeah.
They bought 30-year treasuries, which were very low yielding instruments. And the 30-year treasuries were spent funding current government expenditures.
How's that different from like a Ponzi then?
It isn't. It isn't. The only difference, I guess, is that in a Ponzi, in a classical Ponzi, the money is stolen by an individual rather than stolen by society. But that's the only difference.
All right. You mentioned, and this is going to stir up a little bit of controversy in the comment section because it did with a recent guest who said something similar about the purchasing power of the dollar over a decade, that it loses about 50%. Some people are like, that math is wrong, whatever. I want to hear more on the math for the purchasing power of the US dollar declining by, as you put it, 75% over the next decade. Walk us through the math, the implications, not just here in the US, but also remember the world's reserve currency. I imagine that the effects aren't just going to be felt here.
Ironically, other societies are in worse shape than us, which means I think that the US dollar continues as the world's reserve currency.
Okay.
I think U.S. hegemony declines, which is to say I think it'll be a less important overall component of world trade. But I think that the U.S. dollar will still be the liquidity mechanism of choice because I don't think there's any other alternatives. My friend Doug Casey says the U.S. dollar is an I owe you nothing, but the euro is a who owes you nothing. I think that's a very worthwhile wisecrack. But I think the absolute value of the U.S. dollar declines. Listen, we have $130 trillion in debt to finance. And we also have to pay back the principal. The $100 trillion isn't owed to some mythical creditor. It can't be rolled over. There's a whole bunch of people who rely on these benefits and who believe, and they vote, that they're entitled to them. That's why they call them entitlements. In other words, this is real outgo. The only way that we can honor, if that's the right phrase, $100 trillion in nominal net present value is to inflate away the real value. That's the only way we can do it. Some old, bald, fat, white guy, Rick Rule, who gets $4,000 a month or whatever I get from Social Security, will continue to get it. It's just that the $4,000 won't buy as much. We won't index taxation to inflation. We will index Social Security to the CPI. In other words, we will have a cost of living adjustment that is much lower than the actual decline in the purchasing power of the US dollar. And it's that difference that will skate us through the unfunded obligation that we have to old folks.
Interesting. Okay, so because the CPI is tied to, I guess, like what they might have to pay folks from Social Security. So you're kind of contending here that the CPI might not be, it won't be reflective of like the real inflation that everybody's probably going to feel and notice, and they're probably going to intuit this, but it might not be reflected in the actual numbers then.
You know, Julie, I love this topic. I like to refer to the CPI as the CP lie. If you regard inflation as the reduction in the purchasing power of the currency, the CPI is a flawed index. First of all, it's hedonistically adjusted. They decide what your apartment's worth, and then they adjust the component for rent. They decide what utility you get for your computer. So the price you paid doesn't matter to them. It's how they hedonistically adjust it. But most importantly, the CPI doesn't include tax. Oh. If I didn't have to pay the tax, I might not complain so much about the index. But federal government expenditures are 35% of GDP. They will tell you that CPI inflation is 2.5% a year. Now, ask your listeners to employ their common sense. Take themselves back to 2020, let's say, and think about whether or not the cost of living has increased by only 2.5% since 2020. How has your property tax done? How about your income tax? How about gasoline prices? How about mortgage interest rates? They've doubled. Mm-hmm. How about the cost of food? Uh, Food has gone up so much, it's a political issue. The idea that the purchasing power of your savings has only gone down by 2.5% in the period 2020 to 2025 is laughable.
Mm-hmm.
For people living on the balance who are many, many, many people, while it's laughable, it's not funny. It is this gap between the way that you've been schooled to think about inflation and the way inflation is that will allow the sleight of hand, that will allow the fraud to take place over the next 10 years that makes our aggregate debt affordable to society. People can criticize this in the comments, but they need to take account of it. When I have these conversations, people say to me, well, I paid into my Social Security for 40 years. Yeah, okay. I paid into it for almost 60 now. Right and wrong isn't about arithmetic. Arithmetic is about fact. And people who are counting on a continuation of their benefits need to understand that the nominal benefit will continue, but the real value, the net present value of that benefit will be inflated away. And you'll need to make increasingly better provision to take care of yourself and your family and your friends on your own account of your own volition.
You mentioned the taxes part, which I find so interesting. I was just thinking about that. When you said that, it's like, we're paying not only like our income tax, I feel like everything. I paid for a hotel last night and I like looked at my bill and I saw the taxes I was paying and it's like, dang, it's pretty high. So it's constant. It's like throughout like our everyday lives, we're just constantly paying taxes. That's an interesting concept to like, you're the first person who's brought this up, like when it relates to inflation.
And that $100 trillion, well, the $130 trillion that I talked about, the debt, that's just future inflation. In other words, inflation is baked in the cake.
Yeah.
There's only two alternatives. There would be a depression and a reset. In other words, we could have an honest default where we said to the bondholders, too bad, so sad, no money, strong letter to follow. And we said to the old folks, Walmart's calling, get a job as a greeter. Or we could have a fraudulent reset, inflation, kick the can down the road and deal with it by gradual devaluation. I suspect that we'll choose to kick the can down the road.
Yeah. I wish there were like a prediction market on that because I would probably say the same thing. And that's how it's always been. Okay. One of the things you brought up back in January, and I thought this was so interesting because I got to say, I was hopeful, Rick, obviously was wrong, but you said at the time DOGE was fiction. And I think some of us did get hopeful that maybe they would be successful or at least do something, at least have that conversation. I want to get more of your thoughts on DOGE because I know that's been a disappointment and a disaster, but you were so early to call it fiction.
Yeah, I mean, it was a lie. It was a well-intentioned lie. When I was a younger man in 1980, Ronald Reagan won a landslide election, not a narrow election like Trump. And he ran that election on smaller government. And the political class, the people who are elected to defend their constituents' benefits and also defend their constituents from the claims of other constituents, derailed the Reagan Revolution in 6 months. I would highly recommend all of your listeners to read a book called The Triumph of Politics by David Stockman. If you read that book, you will understand why DOGE failed. There was a wonderful quote. I think it was from Al Gore, hardly a conservative, not Al Gore, I'm sorry. I forget the guy's name. Gore Vidal. That's how I did the Gore. Gory, in other words. Gore Vidal, who said you understand politics by looking at the roots of the words. Poly from the Greek for many, and tick from the English colloquial for small blood-sucking insect. If you look at Congress as a manifestation of politics, what you see is 535 small blood-sucking insects. Their job is to steal from other constituencies while defending their own constituency from being stolen from. That's the nature of the failure of the Department of Government Efficiency.
I guess everyone's so like focused on their own self-interest and getting reelected, kicking the can down the road.
Right.
Okay, but the math, though, that you lay out, at some point, the math's just not going to work out, right? Don't we have to eventually, someone's got to make hard decisions, or can you just inevitably just kick the can down the road in perpetuity?
The decade of the 80s, the decade of the 70s, I'm sorry, reset the value of our obligations. They reduced them in real terms by 3/4. At the same time, the very, very, very high interest rates snuffed out inflationary expectation, so that by 1982, we had a reset of the economy. I suspect that this next decade will do the same thing. We will not reduce the size of government, but we will reduce the rate of its growth. We were successful in the period 1980 to 1992, reducing the growth of the U.S. government, even under the Clinton administration. The consequence of that is that the economy's growth was able to sustain the newly reset debts that we had incurred. And I believe that's what'll happen. I believe that that the government won't shrink, but it will grow less fast. And I believe that $130 trillion in liabilities will become manageable when the real net present value of that is $35 or $40 trillion, as opposed to 135. Taxes will not be indexed to the real rate of inflation, but the obligations will increase in a nominal sense much more slowly. And that gap, the gap between the CPI stated rate of inflation and the real rate of inflation, will be borne by beneficiaries.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. I want to bring up another topic with you because, again, you were so on this point too, and that has been gold and gold's rally. And you talked even like going back to, I want to say it was August of last year when we had you on, you were talking about the stage was set for gold to rally. Talk to me about the what we've seen as it relates to gold, and is gold moving because of this perception of like this loss of purchasing power in the US dollar? What's kind of driving it, and how do you continue to see that playing out?
Yes and yes. Gold traditionally has moved for many reasons, but it's moved primarily because savers were concerned about the maintenance of their purchasing power in fiat-denominated instruments. Beginning in 2022, but really beginning much earlier, people were increasingly concerned about the maintenance of their purchasing power in US dollar, given the debt and given the deficits. Those fears were well-founded. If you look back to the decade of the 70s, which I just described for you, as a decade where the US dollar lost 75% of its purchasing power, it's instructive to note that the gold price ran 30-fold. Now, I'm not suggesting that gold rises 30-fold from here, particularly because it's already up 12-fold in the period 2000 to 2025. But I would suspect, with no reason other than simple arithmetic, that the increase in gold price will more or less mirror the deterioration in the purchasing power of the US dollar. If the US dollar loses 75% of its purchasing power, it wouldn't surprise me at all to see the gold price increase 3-fold or 4-fold in a nominal sense in the next 10 years.
What would that be, like 9? Wait, where is it today? I'm looking at
34.
34.
10,000, 12,000, some number like that.
Okay.
Understand that what will really happen is that gold will maintain its purchasing power, while the dollar will lose 75% of its purchasing power.
What would that also mean for like U.S. dollar assets?
Well, it depends on what you call an asset. I guess my suspicion is that many assets that aren't easy to construct will maintain their value, increase in nominal price, but maintain their value. The challenge will come, if past is prologue, in that over time, the deterioration in the purchasing power of the US dollar will increase the interest rate that savers demand on their savings. In the period of the 1970s, the prime interest rate, if my memory serves me correctly, moved up from 5 to something like 16. I remember myself paying a 15.5% mortgage. So assets that whose acquisition has traditionally involved a lot of debt, if past is prologue, if interest rates triple over the course of the decade, which they might, will prove fairly challenging. The loans to value and the debt service requirements around highly leveraged transactions, around highly leveraged real estate, will become much more challenging in the next 10 years. So when we talk about the price of assets, the affordability is an example of a single family residential house where you're paying 5% first mortgage or a 7% first mortgage. The affordability of that, or say the cap rate, is much different in a 7% mortgage environment than it would be in a 15, 16, or 17% mortgage environment. And people need to take that into account.
Yeah, I got to say, it's been quite a frustrating market for someone who wants to buy a first time home. I am noticing though more supply coming online and some prices starting to come down. I'm monitoring very closely because, yeah, I would like to find the right opportunity.
You will absolutely have that opportunity. Be careful what you wish for.
I know, right? Because you know what I'd say, like, it might be nice if gold went up threefold, but then also at the same time, I'm thinking, what kind of world would it be if gold's up threefold? I mean, I own some gold and I've owned gold since 2011, but which was a terrible time to get in, by the way. I just never sold it, even when it went down. I got in August 2011, but I've held on.
One smart thing I was able to do as a young man in the 70s, I guess because I was cheap, is the first house I bought was a triplex. And I lived in a basement bachelor suite and rented out the 2 nice suites above me.
That's pretty smart.
So that although I sacrificed in terms of standard of living when I was young, I allowed my tenants upstairs, and the rents went up in approximation of the inflation. My mortgage was always serviced by my rents. And I was able, through the decade of the 70s, to take advantage of other revenue properties where the increase in interest rates made those properties unaffordable for the people who owned them. So I was able, in the decade of the 70s, not merely to survive, but thrive.
That's smart, Rick, yeah.
Many people are unwilling to buy a triplex in a not quite prime part of town and live in a basement bachelor suite, while allowing people who are less wealthy than them to rent the nicer suites and subsidize the mortgage. It worked for me.
It's pretty smart. I feel like you have a lot of these like great kind of like financial lessons. You know, I actually don't know your origin story. I know you went to school in Canada, as you mentioned before, like not wanting to be like in California during that time period. But how did you get into this business? And like, what was your interest in, pursuing this career? Because I actually don't know, and I'd love to hear.
Well, this will generate a lot of hate in the comment section.
Oh, no, come on. We love Rick, so y'all better be nice.
You wait. As a young man, I liked to be out of doors. I was fascinated with geology. I was fascinated with biology. I was fascinated with agriculture. And I was attracted to natural resources. I knew a couple of farmers. And one of them, I remember, told me a farmer's 8-hour day ends at noon. He's got another one just like it right after. And he suggested that I go into natural resource finance as opposed to natural resources. Seemed like a good idea to me.
Yeah.
The second thing that was happening is in the late 1960s, when I was looking around at colleges to go to in California, and the social turmoil was active. One of the reasons for the social turmoil was the war in Vietnam. A young American boy was going to travel. And I decided, so I had two choices. One was Vietnam, a warm place, pretty girls, but they shot you. And the other was Canada. And so I chose to go to Canada. It turned out that my draft number was very high, and I wouldn't have been drafted anyway, but I wanted the choice to be mine, not theirs. Mm-hmm. So those three things, really. The fact that the University of British Columbia, when I went, was a great big engineering school with a little liberal arts department in a Quonset hut down the hill. So a very quiet campus. The fact that I could choose whether to be drafted or not. And the fact that that school had a school of natural resource finance is what caused me to emigrate to Canada. One of the lucky breaks of my life, the decade of the 70s saw a tremendous boom in natural resource stocks. And for the exploration part of the Natural Resource Center, the epicenter of that boom was Vancouver, where I literally accidentally, happened to find myself.
That's awesome.
It was a spectacularly fortuitous set of circumstances.
Yeah. Were you always a libertarian, or when did you kind of like become a libertarian?
I always was. I just didn't know it.
Right.
My political philosophy when I was a young man was, if you leave me alone, I'll leave you alone. Mm-hmm. I thought that libertarians were the Lyndon LaRouche types, the ones that walked around airports wanting to nuke whales. And
we're not related, by the way.
I thought Jane Fonda was kind of cute. I liked whales. I didn't have anything against whales or Fonda. I just wanted to be left alone. Yeah. In high school, I read the Ayn Rand books, and I didn't draw the connection between objectivist and libertarian. It wasn't until some study of that dismal topic called political science and political philosophy that I came to hear libertarians described, and I didn't have any interest in them. A young man, if you go to a college club that doesn't have any girls in it, like, why would you bother? And an on-campus libertarian group probably had, 8 or 12 young math students, so I didn't have any interest in it at all. I became a self-identifying libertarian later when I learned what one was.
Okay. You mentioned, obviously, you are so well known in the world of natural resources. We have talked about gold. I kind of want to tick through some areas with you that could be of interest to this audience. Things that have come up in prior conversations. I want to get your take on copper, because this is a topic that has come up recently on the show. I'm just going to tick through some of them, and I want to just hear your take, how you're thinking about it. But let's start with copper.
I love the copper business because copper mines are often great big mines, and big mines make you big money. If you're going to take the risk in mining, you got to play for big stakes. Any number of copper mines in the world make $2 or $3 million a day. Big money. There is no doubt, Julia, that we have underinvested in copper exploration, development, production for 30 years. And looking 5 or 6 or 7 years out, there's going to be supply shortages. In the near term, however, copper is economically sensitive. And the prices of industrial commodities, including oil and gas and copper, suggests that we are either entering or near to entering an economic slowdown. I'm no economist. Don't get me wrong. I'm not. But commodity prices tell us that near-term demand is faltering, and there is an expectation for continuing faltering demand, what that means is it might be 2 or 3 years before the copper price moves. When it moves, it will be spectacular. In the decade of the 70s, despite a very weak economy, for the reasons we've already talked about, the copper price moved from 30 cents in 1970 to $1.50 in 1980, a function of underinvestment. we will see similar moves. Remember that the type of inflation that I've talked about increases the cost of production adds, new production, and makes existing production much more valuable. And copper will be a prime beneficiary of that. Putting a big copper porphyry into production today takes $7 or $8 or $9 billion.
I've heard that it's really expensive to get one online.
If you reduce the purchasing power of the dollar, simple arithmetic says that $8 billion bill becomes a $25 billion bill by the end of the decade of the 70s. The people who are already in production don't have to pay that cost.
Interesting. You mentioned copper kind of is a bit of a signal too for where the economy is headed. I think that's why they call it Dr. Copper too, because it kind of can diagnose the health of the economy. I'm looking just using the prediction markets. We like to look at the prediction markets with our friends at Kalshi, and the odds of a recession this year, they're currently sitting at 27%, which is down from the start of May. They were like north of 69%, just odds of a recession. From where you sit, do you see a recession ahead for us, or how are you thinking about the economy?
I'm not smart enough, Julia. I really am not. I'm a credit guy. Mm-hmm. My discipline is if I loan money, getting paid back. And I have to say, my credit assumptions in the near term suggested in my heart of hearts, I believe in the U.S. we're in a recession.
Interesting. Right now.
If you look at the oil and gas price before the hostilities between Israel and Iran, they were below 60. And they were below 60 with flat to declining oil production. When the oil price goes down on reduced production, it means that consumption is soft. And that is a real leading indicator of recession. We still generate a lot of jobs in this economy. And ironically, the higher end jobs are going begging, which is to say we're short of really skilled workers. But there's a lot of people in the U.S. who 60% of the population is living paycheck to paycheck. And that's not a prescription for a strong economy. So my operating assumption is that the economy is soft and that as normal interest rates rise, the economy gets softer. It's very worthwhile noting that despite the efforts of the Trump administration, both parties in Congress, and the head of the Fed to talk down near-term interest rates, long-term interest rates keep rising, which is to say the bond vigilantes
they're
who left their ugly heads during the Clinton administration have returned to the market. People are demanding more compensation for their savings, and a higher cost of capital is hard on a liquidity-driven economy. So my operating thesis is that our economy continues soft and perhaps gets softer.
Okay, so speaking of the Fed, again, looking at the prediction markets from Kalshi, number of rate cuts in 2025, they're forecasting 2 cuts. We have the FOMC this week. I think most folks are expecting nothing, no change. What's more of your outlook for the Fed and interest rates?
The institutional bias of the Fed is for higher interest rates. The employees of the Fed, the ones I know at least, and that's not a representative sample, but the ones I know, believe that the Fed is the last wall against the destruction of the U.S. dollar. But the Fed is very politicized, and the political class wants lower interest rates. The right thing to do would be to get out of the way, let the market set interest rates. But it's likely if the economy continues to deteriorate that there will be bipartisan support for cutting the interest rate and the Fed won't be able to resist. If that happens, watch the gold price.
Tell me more.
Well, a cut in interest rate means that they've decided not to defend the dollar. If they decide not to defend the dollar,
gold's going to go up.
There we go. I remember, again, in the decade of the 70s, in 1975, inflation became a real concern. And the Fed and Congress decided to raise interest rates. That interest rate rise in 1975 cratered the gold price. Gold had risen, you won't remember because you weren't alive, but it had risen from $35 an ounce to a high of $200 an ounce, the end of 1974. When the interest rates were forced up, or rather allowed to go up, the price of gold fell by 50% from $200 to $100. But that wasn't the only thing that cratered as a consequence of interest rates. The U.S. housing market cratered. The U.S. Treasury market got obliterated. And the consequence of that is that the equity markets were hit hard too. Congress and the Fed lost their nerve. And in the last quarter of the decade of the year 1975, when the interest rate got forced down aggressively, the gold price went bananas. It just went berserk. It was clear to Wall Street and clear to the savers that the political class had decided to abandon the U.S. dollar in favor of near-term liquidity in the market. And people who were shaken out of gold in that move from 200 to 100 missed a 5-year move from a low of 100 to a high of 850. All of which goes to say, if they cut the interest rate even marginally, never mind aggressively, I think, will see the gold market go in earnest.
Oh, wow. Yeah, well, we'll definitely pay attention in this audience. They follow gold quite closely. If I don't ask you this, I will definitely hear it in the comments section. They also follow silver as well. So how do you think about silver?
In my experience, and I'm not a silver expert, although I've studied it for 50 years, in my experience, silver is a later market mover. Precious metals bull markets are led by gold. Then they're led by the high quality gold stocks. That's the phase of the market that we're in right now. Leadership has gone from gold to the biggest and the best gold equities. About midway through a gold bull market, when the price momentum in gold has made the precious metals narrative interesting to the generalist investor, and the generalist investor comes into the precious metals market, silver outruns gold. Perhaps because of its lower unit price, I don't know. When silver catches a bid, you won't need me to tell you that leadership has changed. Those moves are really dramatic, really, truly dramatic. I've been through 3 silver bull markets. The decade of the 70s, when the silver price went from $1.15 or $1.20 to $50. The move in the early part of the decade of the 90s, when the silver price went from $4 to $50. A move in the 2000 to 2010 market where the silver price went from 5 or 6 to 50. Those are dramatic moves, tenfold moves. And I'm not suggesting that silver is going to go tenfold this time, but I am suggesting that if the gold market continues, and I believe the gold market is going to continue, at some point in time, you'll see the generalist investor come down to the space and you'll see silver explode. And let me tell you something about the coiled spring nature of this market. I've given you the arithmetic around debt and deficits and why they have to devalue the dollar. Let me give you a different piece of arithmetic. According to JP Morgan Chase, and these numbers are a year old, the market share of precious metals relative to other asset classes in the U.S. market is 0.5%, which is to say, the total value of Americans' holdings in precious metals and precious metals securities are 0.5% of their total savings and investment assets. The 4-decade mean is 2%. If the market share of precious metals relative to other asset classes were merely to revert to mean, demand for the stuff grows 4-fold. JP Morgan Chase doesn't have statistics, but they estimate that the market share of precious metals and precious metals related securities in 1981, the previous high, was 6%. Let's throw that out as an outlier. Let's just suggest that the market share of precious metals reverted to mean, and their market share went from 0.5% to 2%. A 4-fold increase in demand does a truly odd thing to price because you can't increase supplies fast enough.
Wow. That would be something to watch as well. Wow. Okay. Before I let you go, a couple of other areas I'd love to bring up with you because we discussed this. I want to say, Rick, you were one of our earlier guests back in the day when I really had a really small audience. So I will always be grateful for folks like you, amazing guests who gave me a shot when I was really small and up and coming. But I remember at the time we talked about uranium. Is that an area that you're still focused on and find like an interesting opportunity today? This would have been 2022.
If you have a 5-year outlook, uranium's just a no-brainer. It's a total no-brainer. It's even politically acceptable now. When you were, as you put it, a young up-and-comer, the political class and the social class was hostile to uranium. It was the stuff of Hiroshima, Nagasaki, 3 Mile Island, stuff like that. Now, the same morons that vilified me want to subsidize me. The Inflation Reduction Act suggested that these guys should give me a bunch of taxpayer money. How weird is that? But it's like there's wind in my sails that used to be in my front. At the same time that the political acceptance of uranium has undergone a sea change, the underlying arithmetic is spectacular. There's 1 billion people on Earth, Julia, 1 billion people on Earth that have no access to primary electricity. They want to live like you and I live. Mm-hmm. That requires an energy-dense life. We've done a great job over the last 40 years lifting up the poorest of the poor. We've got another 20 or 25 years to finish the job. At the same time, you and I want to live better lives, and that requires more electricity. Data centers, electric cars, all those types of things. So we need more of all forms of energy. The best source of non-carbon generating base load power is nuclear. The best. We're building nuclear plants like mad. We have a supply deficit now. The obstacles, the political and social obstacles to producing more capacity are reducing every single day. Now, I'm not saying this is going to be stair steps to heaven. I'm not suggesting that the spot price of uranium couldn't fall by $5 or $6 or something like that. But the truth is we're using a lot more of it than we're producing, and the supply deficit grows every month. 5 years out, 6 years out, this is an absolute no-brainer investment theme. Just today, my former employer, Sprott Inc., announced a $100 million bought deal to buy physical uranium in their Sprott Physical Uranium Trust product. Demand was so brisk that after 33 minutes, they upsized the offering to $200 million. And I think they'll probably have to upsize it again. There is incredible interest in uranium, and there is incredible fundamentals for uranium.
I have to say, Rick, I love having you on the show, and I can't wait to get you on more often. And I'm looking forward to our quarterly conversations. As we wrap up here, let's leave this audience with some parting thoughts. Anything that you would like to leave them to think about? It could be something that we discussed that you want to reinforce, something that we didn't discuss that you would like to leave them to think about. Also, again, let's plug the upcoming symposium. We will leave a link for folks in the show notes so they can go register, whether it's online or in person in Boca Raton. I won't be there this year, but I'm going to tell you, I will put it out there. I will be there in 2026. I will plan my family vacation accordingly so I can attend in 2026. And hopefully I can catch it online as well. And yeah, anything else that you would like to leave? The floor is all yours.
I'm going to make your life better. I'm going to comp you to my online symposium.
Okay, wonderful.
You can watch the tapes whenever you want to, and I would encourage you to do it. What I'd like to leave your audience with is a sense that the next 10 years are going to be different than the last 40 years. You're going to get through this, and you're going to get through it very, very, very well if you prepare, but you have to prepare. The period 1982 to 2022 were the most benign economic climate in human history. That's changing. You have to invest in yourself. You have to invest in education. You have to save to the extent that your forecast of your future involves massive subsidy from society to you. That's coming to a screeching halt. You have to be very, very, very applied. You have to constantly invest in yourself. I went to Stanford University commencement a couple of years ago, and the commencement speaker at the faculty that I was at, the engineering faculty, suggested that the half-life of a Stanford engineering degree was 18 months. What that means is that in addition to making up for the time that you haven't spent educating yourself for the next 10 years, that it needs to be an ongoing process. You absolutely need to involve yourself in your financial future because society's not going to do it for you. They're going to do it to you. You need to develop enough surplus to look after yourself, to look after your family, to look after your friends, to look after your community. The onus is on you. The time to get started is right now. Now, selfishly, I would suggest that a wonderful way to start doing that is the Natural Resources Investment Symposium. But separate and apart from that, that's just part of the process. I also want to say, again, self-serving, that I try and make it easy for you in natural resources. If you like the way I think and what I have to say about natural resources, for free, go to my website, Rural Investment Media. List your natural resource stocks for free. I'll rank them for you. Costs you nothing. Be patient because I'm about 200 rankings behind. And then go to the Rural Classroom. There's 200 hours of instructional programming there, including an 11-part series on Introduction to Natural Resource Investments for free. Remember, those two services are free. Come to my conference. That's not for free, but there's an absolute money-back guarantee if you're not careful. But don't stop there. Read books like Economics in One Lesson by Hazlitt. Read books like The Intelligent Investor by Graham. It's important that you invest in yourself, that you invest in your knowledge base. It's important that you take a considered view of your future because you're responsible for it in a way that hasn't been the case for the last 40 or 50 years.
I think that is such a wonderful place to leave it. And Rick, I have to say, I love learning from you. I love listening to you. Rick Rule, CEO and founder of Rural Investment Media, co-founder of Battle Bank. Thank you so much for being so generous with all of your time, all of your knowledge, your wisdom, your ideas, helping us all learn and get better. And what a great message to leave for folks that it's our individual responsibility. Really appreciate you. And I look forward to our next conversation. And I wish you a wonderful symposium. I can't wait to catch it online, and I look forward to attending in person in 2026.
Thank you, ma'am. Thanks for your support.
Thanks, Rick.